When it comes to stock investments, the number one question on everyone's lip is which stock should I invest in? Should I invest in the Nigerian stock market or should I invest in the US stock market? Hi there, welcome back to my YouTube channel. My name is Adereke Lawal and I'm a lawyer. I major in capital markets operations. On this channel, we talk about everything finance, money, what to invest in, how to invest, and where to invest. If you are new here, congratulations on finding my channel. You are about to be richer. When it comes to stock investments, the number one question on everyone's lip is which stock should I invest in? Should I invest in the Nigerian stock market or should I invest in the US stock market? So before I answer these questions, I'm going to talk about what stock investment really is and the factors you should consider before making a decision to invest in the stock market. The simple definition of stock investments is buying into the ownership of a company. For instance, Said has incorporated a company. Said has 100% ownership of the company. The company belongs to Said. However, Said wishes to expand his business across the 36 states in Nigeria and he has no money to do that. So one way Said can go about getting money to expand his business is to approach external parties and ask them for money in exchange for ownership in that company. So we have Muiwa, we have Tomiwa. Muiwa has 500,000, Tomiwa has 2 million naira. Let's assume that the money Said needs to expand his business is 2.5 million. Said can approach these two individuals and say, if you give me the 500,000 with you give me 2 million naira with you to expand my business, I will part away with 50% of my ownership, which means that the 100% that Said has, Said is retaining 50% and giving and sharing 50% between Muiwa and Tomiwa. What Muiwa and Tomiwa have done basically is stock investments. This means that when you buy a company stock, you become a shareholder of that company and you can share in the dividends when the company declares profits. Also, there is usually a price attached to a company stock. So for instance, if you enter the stock market at 5 naira, which means you are buying a unit of the company's ownership for 5 naira, it can appreciate over time to 20 naira, 15 naira based on the profitability of that company. When a company is profitable, it becomes attractive to investors and the higher the demand, the higher the stock price. So the very first thing you want to do is to narrow down the sector you're investing in. Which sector do you consider profitable in the country you're investing in, whether you're investing in the US or Nigeria? So which sectors do you consider profitable in these countries? So are you investing in the oil and gas sector? Are you investing in the banking sector? Do you consider the healthcare sector profitable, or do you want to invest basically just in tech companies? So after picking a particular sector, it's time to look at the players within that sector. For instance, if you are looking at investing in the Nigerian banking sector, you look at the tier 1 and the tier 2 banks. For instance, First Bank, UBA, GTB, Access and Zenith, and then you may look at tier 2 banks like Fidelity, FCMB, and maybe Providence Bank. So there are some factors you need to look at when you are evaluating a company's profitability. These factors are divided into two. We have the technical factors and the non-technical factors. In this video, we'll be talking about the non-technical factors, and then in the next episode, we'll talk about the technical factors. So the first factor or the first question you need to ask is, what does the company do? This will help you answer the second question, how the company makes money. So when answering these questions, I always like to make example of Apple. Everybody thinks Apple only makes money from iPhones and MacBooks, but that's very far from it. Apple makes a lot more from services and accessories. So you have the App Store, you have the podcast, you have Apple Music, and you also have iTunes. Also, when it comes to accessories, you have your chargers, your AirPod, iWatch, and a host of other things Apple is onto. So this means that you need to do your research on what a company does before you can adequately answer this question. You can have a general view of what a company does and how they make money, but when you do your research, you realize that they might make much more from other things that you know nothing about. So looking at the banking sector in Nigeria, we have First Load Co., GTCO. First Load Co., you think about First Bank, GTCO, you think about GTB. But the truth is, First Load Co. contains the bank and other subsidiary. Also, GTCO contains the bank and other subsidiaries. So for First Load Co., you have the bank, the subsidiaries, including the asset management ABN Quest and the registrars. The same thing for GTCO. So you need to understand what a company does to be able to determine the extent of the company's profitability. So another factor you need to consider is the company's competitors. Who are the company's competitors? This factor is very important because they are competing for the same market share. If a company is the only player in the market, it will make much more profit than when there are two or three or four or even five. A good example is Nokia. Nokia used to be this hot company back in the days. Everybody was using Nokia phone and everything. And then currently the share price is around $5. Meanwhile, Nokia stock price used to be like 20 something dollars back in 2000s. So you need to take competition very seriously. The company you want to invest in, are they taking any actions towards innovation, towards evolving into, because like it or not, consumer states will keep evolving and change is the most constant thing. So you need to check what the company is doing to keep up with the trend. Also, if you are dividends oriented, you need to check if the company has been paying out dividends year to year. Lastly, you need to consider their risk exposure, legal, regulatory, and financial. Three things are not negotiable. You need to check out news on the company, whether they've been compliant with their regulatory body regulations. For instance, if you want to invest in the banking sector, you need to consider whether that bank has been compliant with CBN rules. The recent recapitalization, are they going to meet up with the capitalization, or is there any possibility of them failing? So apart from regulatory compliance, you also need to check the corporate governance, the structure, who is at the helm of affairs. Also, when it comes to financial risk exposure, check out the company's website to find the audited financial statements or AGM reports, because all companies, all public companies have been mandated to publish their reports on their websites. So check out their websites, and when you check, you're checking for assets against liability, how much profits they've made in the last year against what is happening now, and you just get like a general overview of what the company is about, the people at the helm of affairs, the auditors, the directors, profiles of the directors are usually contained in the AGM report. So generally, so when you're checking out when you're checking the balance sheets or financial statements, you're checking the asset against the liability. If they have any debts, liability, like what the company owes, the assets, what the company owns. So this will help you make more informed decision. If you enjoyed this video, please give us a thumbs up. Go to the comment section and comment, say anything, ask question. Also, please subscribe. Thank you for watching this video. See you in my next video, where we'll talk about the technical analysis, PE ratio, earnings per share, how you can determine profitability of a company from formulas. Bye.